How's it going, guys? It's Average Income Investor. Today I wanted to go over my broad investing strategies, my goals, as well as my Roth specific strategy. My main investment strategy is to buy productive assets and hold them until I retire and beyond. Companies that I believe will grow well into the future. My goal is to eventually be able to retire living off of the dividends from my portfolios. In my Roth account here, my goal is to grow my capital as quickly as possible. Because your gains are not taxed so long as you don't withdraw until the age of 59 and a half, I believe this is the best way to take advantage of that. With my time horizon of 30 plus years, I have plenty of time to invest for capital appreciation, then transition my portfolio into one that I can live off of the dividend income. I'm taking the core satellite approach, where I have the majority of my money invested into ETFs. I believe this is the safest way to invest. This strategy allows me to be diversified without needing to take the time to do in-depth research on each individual company held inside. As you can see here, I have 45% of my money going into these three broad ETFs. DIA is an ETF that tracks the Dow Jones Industrial Average. This gives me more exposure to well-established industrial and healthcare companies. Now I have 40% in SPY. SPY is an ETF that holds the top 500 companies weighted by market cap. This just means larger companies like Apple will make up a higher percentage than smaller companies. SPY is one of the safest ETFs to invest in my opinion. 60% of actively managed funds underperformed the S&P 500 in 2020. This just means that most people are better off investing into the S&P 500. That's why I have it as one of my largest holdings here in my Roth IRA. Last but not least, we have QQQ, which makes up the last 20% of this slice. QQQ is one of the most well-established growth ETFs. It tracks the NASDAQ 100, which just means that it invests in the top 100 companies minus financial companies. As of right now, it has 65% of its holdings in the tech sector. I believe this gives it the highest growth potential out of these three ETFs in the future. Now you may be wondering, if I believe QQQ has the highest growth potential of these three ETFs, why do I only have it as 20% of that slice? Well, if we back out of here, we can see that I also have 25% of my money going into my tech slice. 50% of that is going into VGT. VGT is one of the best tech ETFs. It has 364 different holdings diversified all throughout the different tech sectors. This is honestly one of my personal favorite ETFs for long-term growth. Now, the other 50% of my tech slice is broken up into 8 individual tech companies: Google, Apple, Microsoft, Adobe, ADP, AMD, Snowflake, and CrowdStrike. I believe that these are all world-class companies. If you look at any one of these companies' financial records, you will see that they're growing their profits exponentially year over year. Take Google for instance. As big as it is, it has still almost doubled its gross profit within the past 5 years. And if you look at Snowflake, you can see that its gross profit grew from 44.9 million in January 2019 to 349 million in January 2021. That's truly explosive growth. And with this current market rotation out of growth stocks, I'm looking forward to getting these great companies at even more of a discount. If we back out of there, we can see that I have 20% going into my consumer growth slice. In this slice, I'm invested into consumer companies like Target, Costco, Amazon, Domino's, McDonald's, Lowe's, and Monster. And I honestly just really like these companies. They're all companies that I'm a consumer of, and I believe they're best in class. Even though most of these companies may not be growing as fast as Google or Microsoft, I believe that they have a lot of room for growth in their future. Last but not least, we have my real estate slice. As you can see, I used to have this be weighted much higher in my portfolio. It's only just recently that I realized I needed to change my investing strategy to line up with my goals. Now my real estate slice only makes up 10% of my portfolio. Now, these are all REITs, which stands for Real Estate Investment Trusts. Instead of owning a stock of a company that sells a product, when you invest in a REIT, you're buying ownership of a company that only owns and buys real estate. That's a good way to diversify against the market. Even though REITs only make up 10% of my portfolio, I truly believe all of these REITs right here are best in class. Prologis is a REIT that owns property for data centers. American Tower is a company that owns real estate for cell phone towers. Realty Income owns the buildings for businesses like 7-Eleven. Vici owns massive one of a kind buildings located mostly on the Vegas Strip. Now, Arbor Realty is a little different. It doesn't invest into physical real estate like these other REITs. What Arbor does is it invests into mortgages themselves and makes money off of their interest. As I get closer to retirement, I plan on investing a larger percentage into REITs. Normally, if you hold a REIT in a standard brokerage account, all of your dividends will be taxed as ordinary income. The special thing about holding REITs in a Roth account is that you will not have to pay the higher tax rate on your dividend. Now that I've gone over all of my holdings, I want to go over how I plan on putting money in the future. What I would like to do is called lump sum investing. This is where you put all of the money that you can invest in as soon as you can. As you can see here, as soon as the new year hit, I maxed out the $6,000 that I'm allowed to put in my Roth account. If possible, I would like to do this every year. Statistically, the stock market is up year over year 75% of the time. This means that lump sum investing is the best way to invest 75% of the time. If you've enjoyed this video of me talking about my Roth IRA, just remember to like and subscribe and follow for more.